And the only way I'm gonna be able to get to that 120 is to adjust this account, isn't it? And so what would I do to, if you've read the chapter potentially, you know this, but how am I going to get the supply account down from 430 down to 120? What would make this account, and don't even look at the name on it, who cares what the name is at this discussion point. If I've got any account with a 430 debit and I want it to have 120 in debit, what do I need to do to this account? Credit it. And that credit there is, I can't remember how much it is.
I think it's
290?
310.
What?
310.
Is it? I don't know.
Yeah.
210?
No, 310.
310.
I used to have my solutions written out over here and I don't see it.
30 tens plus 20 tens.
Yep. So 430 minus X, I'm gonna call it that, should equal 120. So if I put in 310, then I get 120. Okay? But I really didn't want to get into this part right here. I wanted you to see what really needs to happen is that we just need to subtract what we want to have in there from what's there, and that becomes our adjusting entry. So I know I need to credit supplies for 310. So I also know in every single journal entry, there's a debit and a credit. So what would it be that I could debit that would fit in this particular scenario? How about supply expense? And so I'm going to give you a sentence that really, hopefully, kind of resonates with what we just did. And we use it a lot in this chapter. An asset that has been used up, sold, or expires becomes an expense. Okay? An asset that has been used up, sold, or expires becomes an expense.
So, if you sold it, you hope you sell that that gadget for profit.
Yeah. But that doesn't have anything to do with your sales process, though. I mean, that's a whole different scenario.
Okay.
Okay? So, in a sale type situation, the expense is cost of goods sold. You sell something, but you got a cost that you had involved in the cost of it. This is just a very good accounting sentence that it will behoove you to think about what's happening here. An asset is only an asset to us if it meets the criteria that we own it, it has monetary value, and future benefit. Well, what's wrong with those $310 worth of supplies there that make them not fit those three criteria? They're gone, number one, right? So they're we don't any longer own those particular supplies. There's no more future benefit to them because we've used them. And so they became an expense. And so always when you're adjusting supplies, this will always be your journal entry. It's just the number figure that sometimes gives everyone the most fits on how to interpret it. But it's always those supplies are gone, so we'll credit the supplies, but they became an expense of doing business. Okay?
And may I put it
Okay.
in these terms to try to help myself understand? It becomes an expense depends, because they're gonna have to be replaced. Your supplier's gonna be replaced, and that will cost.
I mean, you may or may not replace them, but has strictly to do with what we had and we used it. Nothing to do with what we might do in the future, okay? We are literally taking care of the reality of what left the supply room. $310 left the supply room. And we're going to presume it was because we used them in the office or, you know, wherever. Okay? So always supplies, the adjustments for supplies will be to reduce the asset supplies. That's what's happening with that credit, and it's increasing an expense when we record the fact that they have now been used. Okay? So you will see probably a couple of problems, if not more, in your homework dealing with adjusting supplies. And don't overthink it. It is simply the recording of supplies that get used up. That's what they're asking you to take care of. Okay, now another adjustment that we take care of is relative to prepaid insurance, or anything prepaid, actually. It could be prepaid rent, prepaid insurance, etc. And this is 5-2B on same page, 166. So, if you prepay for any kind of an asset, you prepay rent, you prepay insurance, maybe you prepay for some fuel or that type of thing. What is it about prepaid assets that happens? Look back at our little sentence here. An asset has been used up, sold, or expires. Insurance expires, doesn't it? You prepay it. You know, when do you buy insurance? Before or after you need it? Before. You don't go and drive your car around and have an accident, and then you drive by the nearest State Farm insurance sign you see and walk in and say, really, I just had a wreck and I really need some insurance. What are they going to do?
Laugh.
Yes, they're going to laugh you right out of the office. I'm so sorry, but that's just not going to work that way, is it? So we prepay for our insurance. And most businesses write it off as they go along, but sometimes we pay, sometimes for buildings and stuff, we can pay up to a year in advance of insurance. And so we want to essentially every month show what the cost of insurance was that month. Even though we may have prepaid for all of it in January, it's really being used every month a little bit at a time. Agreed? It expires every 30 days. Or every day, actually. So the minute we buy prepaid insurance, the next day, some of it has expired. The minute we prepay for rent, the next day, some of it has expired. But we're not going to be doing an adjusting entry every day an element of insurance or rent expires that we've got on the books. The key point is that prepaid insurance is what kind of an account then? Anything prepaid is... No, think about what it is. What kind of an account is it? Not the debit or credit. It's an asset. Anytime you prepay for something, it gives you that future benefit, doesn't it? We buy some auto insurance on January 1st, then we're good. If we prepay for a whole year, we're good for an entire year. And so it's giving us that benefit of being insured and being able to run our company, etc. But every month, we're probably going to want to do an adjustment to reflect how much of it expired and how much prepaid do we have left. So in problem 2B, it says on July 1st, a 6-month liability policy was purchased for $750. So again, this is on July 1st, 6 months. Insurance was purchased for $750. So I would have debited prepaid insurance for $750, and I would have credited cash when the original entry was done. And I'm not showing you the other side of the coin here, but definitely something had to have been credited when we, bought the insurance. I just want to isolate it down to this prepaid insurance account. That's my asset. If I don't do anything to this asset for the next 6 months, then by the time I get to month 6, I've totally overstated my assets because I don't have 6 months of insurance left at the end of this policy life. So every month, I'm going to make an adjustment to reflect how much of this policy has expired. So, first of all, let's look at the accounts that are affected. What do we say? Anything prepaid or any asset that expires becomes what?
An expense.
An expense. So I will debit insurance expense every month as it expires. And what is expiring? Prepaid insurance, isn't it? And as an asset, it's going to be reduced with credits. So every month, that will be my adjustment. It's just how much is the adjustment. So the easiest thing to do, of course, is to take the policy, the total price, $750, divide it by 6, and that tells me how much that's costing me on a monthly basis. And what is that? Anybody? 125? 120? Anybody got a calculator? $125. So I will debit insurance expense for $125, and I will credit prepaid insurance for $125. And if I were posting into my T accounts, I would credit up here for $125. So at the end of month 1 now, my only remaining insurance is what, $625? I've got $625 left of prepaid insurance after month 1. And this is not part of the problem, I'm just kind of illustrating to you what's happening. Every month we'd be making that adjustment. So what's happening to prepaid insurance every month? It's going down every month as it expires. So this will always be a scenario of your prepaid insurance. Again, it's an asset, it's expiring. We have to make an adjustment every time a proportion of it expires that we want to keep track of it on that time frame. Some companies may only want to do it every couple of months or every 6 months. They want to make this adjustment. But in this course, we're going to presume we should do it every month. Even though I believe there's probably a problem on your homework or your exam that's going to pop up for 2 months expired since we last made an adjustment. That just means somebody missed it last month. In that case, then what would my debit and credit figure be? $250. Then, if I'm recording the expiration of 2 months of insurance, I would debit insurance expense $250, credit prepaid $250. So you have to read the details. If you haven't figured it out, accounting is very detail oriented, and so every little word that's given to you in these problems or in your homework is important. It's not just, usually it's not external information that doesn't matter until we get to 3B. Okay, so any questions on prepaying insurance and what our adjustment is going to look like? Okay, let's look at 3B. It's the same page. Another adjustment that we have to make has to do with expenses that haven't yet been recorded. When you are employed and it's time for you to get paid, do you get paid, let's say you get paid every 2 weeks, do you get paid or let's say that you get paid monthly. Let's say for the month of November possibly coming up, are you going to get paid for November at the end of October? Think about it. That's the job you want, right? Go to work on November 1st and get paid October 31st? Like the day before? That wouldn't happen, would it? No one pays in advance. They're not gonna pay you until you do what? Show up and work. And then the next round of payroll, whether it be every 2 weeks or every month, then your first paycheck will not come until after you have worked for the employer. And so what happens, let's say, it's that the end of the year, December is usually the only time we really worry about this. And the last 2 weeks of December, we've got some employees that have worked those 2 weeks, but yet payday isn't gonna be until January 3rd, which is very common. You work a couple of weeks, and then you may not get your paycheck for a couple of days after the pay period ends, if you're lucky. Some, by law, I don't know if you know this, but, most employers don't adhere to it, but they have 14 days to pay you after a cycle ends, sometimes longer depending on the, cycle of payroll that they're using. But we're gonna say that we're gonna pay everybody on the third day after a payroll period ends. We have 3 days to calculate payroll, so now it's the last 2 weeks of December. We've got people out there that have worked, and we owe them money, but yet we're not gonna pay them until January, when we have time to sit down and do all the calculations and stuff. But when did the expense happen? How about December? Sorry, I changed the scenario up on you. They worked in December, we're not paying them until January. But December is in 2020, we'll say it's 2020. I don't want the expense to show up as a 2021 expense, do I? Because it actually happened in 2020, and that's what I mean by the matching principle. We're gonna match the wages, we're gonna record the wages in the period that the employees worked, not the period that we necessarily pay them. Because they could be two completely different periods, and they usually will be. So in 3B it says, on July 31st, the trial balance shows wage expense of $800. I want you to think about that first sentence. What does that mean when they're telling you, on the trial balance, I've got wage expense of $800?
They have paid the $800 to do it.
So far, as of today, I have paid someone, sometime, $800 in wages. So it's already on the books. The next sentence goes on to say, an additional $150 of wages was earned by the employees but has not yet been paid. And they want you to prepare the journal entry on July 31st to reflect this particular fact. So what is the fact? We owe somebody, don't we? What do we owe them for? Wages. And so we're recording an expense on the records that is not there yet, so I will debit wages expense for $150. Why didn't I do something with the $900, that $800 that they talked about? Because why? That's already been taken care of. This is talking about new wages that we owe as of today, July 31st. We owe another $150. And so we want to make sure the expenses are increased by $150 for the period, and we also want to make sure that our liabilities are also reported in the fact that we do owe someone $150 at the end of July. And $450, you know, for the average company, that's not that big of a concern, that if we fail to record this and don't do it until August or whenever, it's not that big of a deal. But what if you are a company that has $150,000 worth of payroll every time you it comes around? What if I had added some zeros there? The failure to record that adjustment at the end of a month understates our liabilities by $150,000. That's a lot that we are not reflecting that we owe someone. And it's also understated our income by $150,000 because it costs us $150,000 in wages that we don't have recorded on the income statement unless we make this adjustment. So that's why this particular adjustment is so important, is that we want to make sure our liabilities are increased for any wages we haven't paid yet, and that our expenses have been increased for any wages that happened that we haven't paid for yet. Okay, so those are, three of what I call the easier, well, I don't wanna use that phrase. Lots of people struggle with adjusting entries, and so, again, it's just real important that you read this chapter thoroughly. Of all the chapters in the book that you need to read more than once or even twice, this is the chapter. Because lots of accounting philosophy is introduced and some terminology that most people have not heard or are putting incorrect thoughts with these particular words, so to speak. Because the next big adjustment that we're going to talk about and the reasoning behind it still goes along with this primary sentence. And that is, we've talked about, of course, assets, some shorter term type assets, short term indicating that supplies and prepaid insurance are never intended to last us longer than, 6 months to a year at the most usually. That'd be the longest amount of time that those particular assets are on the books and that we need to adjust them. And we're literally adjusting them because they are physically gone. Our supplies are gone. Our insurance is gone. That piece of paper that we've got in there saying we had insurance through June 30th of 2021, that's worthless now, isn't it? It's gone. But we do have some assets that stay on our books for long periods of time, what we call our long-term type assets, that they are expiring as well, if you want to look at it that way. Let's say that we've got, Jane and John doing the taxi cab business. What is their big asset that is allowing them to produce cab fares?
Their vehicles.
Their vehicles. And so they buy their vehicles, they put them on the books as a long-term asset, autos and trucks, whatever you want to call it. And as time goes on, that vehicle is literally being used up. An asset that has been used up. How is it that we can still see their cab sitting out on the lot? How can you say it's been used up or it has expired?
Depreciation.
Okay. But barring that word, what is it about that vehicle that we can say we can't see it, but what is being used up or expiring in that vehicle?
Usefulness.
Its usefulness. Because vehicles, on the first day that you buy them, have more longevity at that point than 2 years from today, don't they?
30% off the lot.
Yeah, and that's a market value thing, and that is one thing that happens, except these days. People are selling some used vehicles more than they ever paid for them.
Mm-hmm.
So we're in a very weird predicament here, but what we're referring to is that physical deterioration, the loss of usefulness, simply because John or Jane are using the vehicle, okay? And we call that depreciation. Depreciation, by its definition, is not what you think it is. Depreciation is the used up portion of long-term assets. I know I write horribly, so I'll repeat it. Depreciation is the used up portion of long-term assets. So nowhere in there did I say that depreciation is the decline in value, did I? That's what happens in the real world as far as any asset that you purchase. I don't care what it is, a computer, an automobile, a building. Buildings are a little bit different. Our long-term assets, we use them and they lose their usefulness that they started with. That doesn't mean they're going to be unuseful to us 10 years down the road. It just means that probably between now and then, we're going to start doing lots of repairs and maintenance and this, that, or the other to keep it in working condition. So that cost, though, to John and Jane, if they've got a cab business, definitely they want to reflect the fact that they could not earn fares if they did not have that physical cab. And that costs them money. Typically, the biggest cost of all are our long-term type assets, buildings, vehicles, equipment, you name it, computers, all those things that cost us a lot of money, they're the things that are the very things that make us a lot of money too, usually. So we don't want to forget to add in an expense side. So depreciation expense, or depreciation, is simply that used up portion of long-term assets. So in this particular course, we're going to use one method to compute depreciation, and it's called straight line depreciation method. The straight line method, because we cannot simply look at a vehicle or look at a computer or look at a piece of equipment and say, oh, I think I used about half of that this year. Well, what is that assumption based upon? So what happens is the IRS and accounting authorities basically give us, excuse me, different methods that we can choose from to determine how we're going to estimate depreciation. Depreciation is always estimated. There's no way on God's green earth that we can ever have a 100% defined value of our asset that has been used up from year to year. It is all guesses. Some assets may last longer than others, and some may have a shorter life than others. Maybe you bought a lemon of a car. Well, we didn't know that until maybe 2 years down the road, or a year down the road, or whatever the case is. But the straight line method, what?
I would say bigger your fleet, fewer hours or such would be from each individual fleet.
Yeah.
member.
Yeah, every business is different in how they use their equipment or their automobiles, how they take care of them. It's all, again, the point being, it's just an estimate that we are going to use to figure out what the used up portion is. So the straight line method is very simple. We're just going to take the cost of our asset and subtract from it a salvage value. Salvage value is just a value that we, again, estimate that at the end of this asset's useful life, we're going to be able to sell it for scrap or to take it to the salvage yard, and they're going to give us a little bit of money for the steel or whatever's involved in the particular asset. So we're going to take our cost minus our salvage value, and we're going to divide it by number of useful periods, meaning periods of life, like by months, by years, by hours, whatever it is that we presume our particular asset will last us. So a vehicle typically has about a 5-year life. For IRS purposes, I'm not saying that that's at all what the asset may last for a particular business, but that's what the IRS allows, a 5-year useful life period. So it's going to be the cost of the vehicle minus the salvage value at the end, because the theory is we don't use up the salvage value, do we? Again, all theory. We don't use up the salvage value, therefore we're not going to depreciate it. So cost minus salvage value divided by number of useful periods is a very basic straight line method that basically says every year we're using up the same amount of depreciation. We're using up the same amount of the asset, rather. And it really isn't at all reflective of that asset.
Of that technology, such as computers or
Right.
so forth. Okay?
Yeah, because a computer, you may buy it today, and in 6 months, maybe depending on what you do with it, it doesn't have anywhere near the life that you thought it was going to have. And then some of them last indefinitely. You just never know. I've got, at my office, for tax preparation purposes, I've got a desktop and I've got a laptop. And my laptops last about half the time. And my desktop is always my go-to, but it's of course not as convenient, but it had originally a 3-year life on it. I've had that thing for 10 years, and I just have the same guy come out and, help me update it now and then. But again, these are just estimates. We have no idea what's going to transpire. It could be worthless. I've had laptops that last me a year, and then I'm ready to chunk them and start all over again. So, it's all based upon the fact that depreciation is an estimated amount, not the reality of the situation. Okay? So, in 4B, same page, let's apply this to a problem so that you'll kind of have this as you're doing some of your homework. It says that on July 1st, delivery equipment was purchased for $43.20. So one of the main things about depreciation and the calculation of it and the just the whole scenario of doing adjusting entries is that we need to keep track of every period, where did our figures come from. So first of all, our purchase price on this piece of equipment was $43.20. That's obviously a big piece of our puzzle here. Also, the date of purchase is very important so that we can keep track of how long we've been depreciating it, and this was on July 1st. Then the next sentence says, the delivery equipment has an estimated useful life of 3 years or 36 months and no salvage value. So I'll just make a note here, salvage value estimated to be 0, and a life, estimated life, 36 months or 3 years. Which is, again, going to be dependent upon the company. Do I want to record some depreciation expense every month to get a complete picture of a monthly cost of doing business? Or do I want to wait and do my depreciation just once a year? Really good companies that are really on top of things, they're depreciating every single month. Why?
Stay current.
That, and what else though?
Keep track of, depreciation schedule, so they know when to replace it for tax benefit.
Yeah, I mean, they, you know, you want to keep track of what you're doing, but isn't that, for particularly this company, it's delivery equipment, and they're obviously some kind of delivery company, that delivery equipment is a big cost of their business, isn't it? And if they want to find out what I'm really making on a monthly basis, don't they need to be reflecting this on a monthly basis, that the cost of my equipment for this month was X amount of dollars? I mean, if you only do it once a year, which most companies in reality, that's what they do it once a year. But if they really want to keep track of real profitability, they want to do it monthly to reflect every single month it's costing me a little bit to have that piece of equipment out there. Just like insurance, it's costing me a little bit every single month to have a prepaid insurance policy. Rent is costing me something every month. Have you ever done a budget for yourself on a monthly basis? You calculate everything that you can think of that is costing you to live for that month, right? And if you leave out a piece of the puzzle, then you're not having a true picture of a good budget. So that's why we depreciate on the monthly basis. So in this particular problem, eventually it comes down to, we know what we need to do here, because it says, using the straight line depreciation method, analyze the necessary adjusting entry on July 31st. For this particular asset's depreciation. Well, look, we bought it on July 1. They're asking you to prepare a journal entry on July 31st. How many months are we going to reflect the depreciation in this particular journal entry? If I bought it on July 1st and today's July 31st, how much time has transpired since I bought it?
A month.
A month. 1 month. Okay? So I want to use the 36 months in my calculation is my point. In that my cost was $43.20. I had 0 salvage value, and I wanted to depreciate this over 36 months. I want to get a monthly figure here for depreciation. 120? I don't know. I don't know if I told y'all at the beginning of the semester or not. I don't do math, but my phone does. But I never say that to my clients, because they look at me like, what? I think I'm crazy. It's not that I don't do math, it's just that I have tools that help me, right? We all have tools. What's that old saying? If y'all have ever had my husband for economics or had him, his expression is always, work smarter, not harder. Well, that's why you have calculators and 10 keys and computers. So what is my entry going to look like then? Every month I'm going to be recording $120 of this particular piece of equipment has expired or been used up. So the first thing I'm going to debit is an expense, because it just said in my little sentence, what does it say? An asset has been used up, sold, or expires, becomes an expense. So I'm always going to debit an account called depreciation expense. And here, 120. Now, if you have read your chapter, or when you get to the reading of your chapter, you're going to find another principle of accounting called the cost principle. And the cost principle of accounting very simply states you never ever credit an asset unless it has been sold, a long-term asset, unless it has been sold, abandoned, that type of thing. We don't go in there and just credit equipment. That would be the logical thing, wouldn't it? Debit depreciation expense, credit equipment, because we just used up some of it. We want to reduce its value. But for tax purposes and accounting other purposes, what we're going to do is create a contra asset account. Again, all this is in your reading, called accumulated depreciation. Something right there. And that will be credited for 120. So let's talk about that account, accumulated depreciation, just for a second. Accumulated depreciation is a contra asset account. What does the word contra mean to you? Against. So this is what it's going to look like. We've got delivery equipment in its own little account when we purchased it. And remember, we paid $4,320 for it. So I would have debited that account when I bought it. Everybody agree with that? But every month, we just said, well, this thing is expiring at the rate of, or we're using it up at the rate of $120 a month. Why don't I just go in there to my delivery equipment account and credit it every single month for 120?
Because that's technically an expense, isn't it?
Well, the debit is the expense. So I am debiting an expense for 120. It's the credit. Why don't I just credit delivery equipment instead of this funky named account called accumulated depreciation? And it really has to do with, I don't know if the book describes why, but it really has to do with gains and losses. If you were to ever sell it, you need to have the original cost for reporting purposes. So I'm creating an account over here to hold the used up portion. And that's what I mean by accumulated. What does the word accumulated mean to you? To add up, to gather, to keep track of, to, you know, as like when my son lived at home, he accumulated a ton of laundry on a daily basis. And the pile just kept growing and growing. And that's what's going to happen here. This account's going to continue to grow and grow. Every time I do what? Every time I credit it for the used up portion every month. And so, you know, that was my credit here. And remember, this account, depreciation expense, was debited. These are not the same accounts. Depreciation expense is an expense account. Accumulated depreciation is a contra asset account. So that accumulated depreciation account is basically an offset of or reduction of my original cost. So let me give you a little formula here. If you've ever heard this expression, book value of an asset. Well, what does that mean? It means what's on the books, the accounting records. And it is a formula. It's not a number that you can pull up out of the air. You have to go to your books and actually pull up how much should I pay for it, what is the cost, how much do I have in my accumulated depreciation account, and subtract accumulated from the cost, and that equals book value. So how much should I pay for this piece of equipment for July 1st? $43.20, right? By the end of July, I've got 1 month of accumulated depreciation. So if I subtract $120 at the end of July, what is the book value of my asset? Was that $4,200? Everybody agree with my math? $4,200? Okay. So let's say that I had depreciated it another month in August. What, at the end of August, what is my book value going to be? Same formula. Cost of $43.20. But by the end of August, how much depreciation would I have accumulated? Because I would have done the journal entry.
240? Oh,
Yeah.
no.
I lost one.
3,
Journal entry. Oh, there it went. So on August 31st, I'll do the same journal entry again, won't I? Except it'll be August 31st, I'll debit depreciation expense, credit accumulated. So remember, this was on July 31st. Now I've done it again on 8/31, another 120. So right now, accumulated depreciation is equal to 240 now. So now my book value is 43.20 minus 240. But I say that accumulated depreciation is growing every month. It's getting higher and higher. So at the end of August, my my book value is now how much? 4160. Is that right? I'm not sure. 43.20 minus 240 is
I got 4080.
40 what?
4080.
4080. That works for me too. So accumulated depreciation is growing every time I record depreciation expense, and what's happening to book value every month? It's going down. And then that's when we eventually will compute gains and losses, or based upon how much should I sell it for minus my book value. That becomes my gain, not how much I originally paid for it. So this is how, again, we get around the cost principle of accounting. We do not credit delivery equipment every time we depreciate it. We hold that amount in accumulated depreciation, which again is a contra asset account. So what is its normal balance in? If it's a contra asset account, what do you think its normal balance is, obviously? Debit or credit?
Credit.
Credit. The asset has a normal debit. The contra account, if it means to be against the asset itself, obviously then it will have a normal credit. So again, all of this, if you have not had a chance, you'll be reading this in Chapter 5, and like I said, this chapter is definitely one of those that, because the material at hand, you're going to want to read it more than once before the exam. Because if you haven't figured it out, you're timed on the exams, and this is the kind of stuff that if you don't have a pretty good handle on it, when you get into the exam, you'll never finish. If you haven't realized that you only have about a minute to a minute and a half per question when you're taking the exam. So, how many in here, I'll put it back on the camera, how many in here have actually even read Chapter 5 yet? Yeah, I understand. I've been there, done that. I'm never going back to school as long as I live, so, for that reason. So, when you get the chance, just make sure that you have read this chapter, and then everything that I'm talking about in here today hopefully will click a little bit more. Okay? And I believe in this chapter they're going to, in your homework, you potentially have some, worksheet problems where you're introduced to a worksheet that accountants use, especially by hand, and I don't want you to get too, overwhelmed with those. Do the best that you can to answer them, but they're very time-consuming type questions.
What helped
And I
me-
do make some adjustments
What
later
helped
on.
me is when I was checking my work, the
Mhm.
box down at the bottom, it always drops down, you know, says, it'll even tell you your starting point is right here, and it always goes up to just what you said much earlier on the problem,
Mhm.
the word problem, if you wanna call it that.
Yeah.
The information in there isn't non-essential. There's a key there that they're telling you, that blue box, reread that.
Yeah. Right. It's asking you, I think, to kind of
Gives you
fill
your
in,
starting point.
yeah, it's giving you some fill in the blanks to start with. Okay, so, really that's about all that I have for today. Chapter 5 is gonna be one of those that you just have to spend some time on it. I'm just kind of warning you, so, but, you know, if you're doing your homework and stuff and it's not at the last minute, you can email me and I will, certainly be able to help you, with that. But get started on it because this homework is a little bit more time consuming than some of them. How about that Aggie game? It was good.
Yeah.
How about that tech game? Not so good.
Hey,
Poor Ted.
You're a tech graduate or that?
Tech. But, you know, you gotta root for some team that's winning, so. And any team that can beat Alabama, I mean, my goodness.
Kinda like, it's like you said,
Yep.
Alabama needs to get beat once in a while.
Yeah, UT all the time.
Thank you, have a good one.
Y'all too. Annabelle, did you have any questions? I know that it's hard for you to interject now and then.
No, ma'am.
Okay.
No, ma'am.
All right.
Thank you.
Uh-huh. So you're an accounting major, right?
Mhm.
Yeah, I can kind of tell you're getting it, so.
Yeah, I am, but actually, it's been